Hello, my name is Robert Promisel. I'm one of the portfolio managers at Resolution Capital, managers of the Ned Investments Global Property Fund. Thank you for meeting with me today as we discuss the 1Q 2024 Global REIT performance results. Global REITs had a challenging quarter, January to March of 2024. We saw yields increase on a global basis that led to pressure on a number of different sectors and segments. That being said, the Ned Global Real Estate Fund outperformed the market overall due to its exposures in Japan, in Australia, as well as the sector exposures in data centers, diversified, which really refers specifically to one very large position in Japan, as well as the office holdings. Detractors to performance included self-storage and Hong Kong. As I said, we saw rates change in the first quarter. For the direct market overall, there continues to be limited transaction activity. We have seen cap rates and investment yields on direct properties increase. This is happening all the while the operating fundamentals remain really quite sound for commercial real estate on a global basis. Balance sheets for global REITs are very strong, with the exceptions being parts of continental Europe and some of the office stocks, particularly in the U.S., where we've seen dividend reductions over time. See here performance for the fund over the past quarter. This is net of fee, as well as the past 1 year, 3 years. Let's just dive into some of the attribution. Diversified and Japan go hand in hand because the largest exposure in that region was to Mitsui Fudosan, which had a very strong performance in the quarter. It's a dominant commercial landlord in Japan with major office exposure in Nihonbashi, which is a sector in submarket in Tokyo, as well as the Latitude regional shopping center portfolio. Mitsui Fudosan is also embarking on improved corporate governance and rationalization of some non-core holdings that are likely to be used to fund a share buyback. The office exposure in the quarter also contributed to performance, as we saw strong leasing, certainly in the first part of the quarter, which eventually did fade as the quarter went on. The industrial exposure in the fund contributed to performance primarily because it was an underweight exposure. We continue to see moderation in the leasing environment for a number of key markets on a global basis, particularly Los Angeles, which is a major import market in the U.S., as well as softening leasing conditions in other markets such as New Jersey and Chicago. The hotel sector had a strong performance in the quarter, really powered by the fund's exposure to Host Hotels, one of the largest hotel owners in the U.S. with a very strong balance sheet. And then on the bottom end of performance, we saw self-storage was detractor to performance. That really resulted from two different thematics. One, in the U.S., we continue to see softening conditions in self-storage. This is really the backside of the COVID pandemic boom. We also saw a soft trading environment for the UK-listed hotel REITs, where we have a large position. We think there's good value there and remain committed. Moving over to the right side of the page, we've talked a bit about Japan. The other holding we had in Japan, Mitsubishi Estate, which is a very large landlord, the dominant landlord in Marunouchi, which is the core office primary business district that's located between the Tokyo Central Railway Station and the Imperial Palace, had a very strong quarter. In Australia and New Zealand, really the positive performance resulted from the strong overweight to Nedgroup, which is dominant regional shopping mall company in Australia, formerly the Westfield portfolio. And in Europe, we had an underweight exposure to German residential, and a really big contributor to performance was Roundup, which re-entered the portfolio last quarter. It's a dominant, large regional shopping mall owner in continental Europe, the UK, and the US. This had been a core holding for a number of years that we exited just before the pandemic, when they increased their leverage considerably as they acquired the Westfield portfolio, which gave them two very important large assets in London as well as a US exposure. They're in the process of reducing their leverage, and just this past quarter, they've reinstituted a dividend, which we see as a very positive sign for cash flow generation going forward. See here the sector exposure and significant overweight relative position in data centers, very constructive on the outlook for data centers and for leasing demand going forward, in part fueled by AI and the increased demand that AI will place on data centers. There'll be increased densification, greater power utilization, additional needs for cooling, all of which means that demand is going to be quite strong relative to the ability for supply to meet that demand. The portfolio has two large exposures. One of the largest positions in the portfolio is Equinix, and then also Digital Realty, both are US listed. Residential is an important sector, important exposure for the portfolio. It's really a rental housing exposure dominated by the footprint in the US, both purpose-built apartments called multifamily, as well as single-family rental, and also manufactured homes, mobile home parks. The portfolio has exposure to German residential through TAG Immobilien, which is a large owner in primarily Eastern Germany as well as Hamburg, and then also has a growing development portfolio in Poland, which is a higher growth market. The portfolio's exposure to retail, as I mentioned earlier, with Roundup and Center, was a positive contributor to performance and an overweight for the fund. And then healthcare is also an overweight, really dominated by seniors housing. One of the largest positions in the portfolio is Welltower, which is the largest owner of private paid senior housing in the US, with a very strong growth profile. At the bottom end, of course, I mentioned earlier, industrial, which was a detractor. Part we had softening conditions there. See here how the portfolio is comprised by geography. The US continues to be the largest single market exposure for the portfolio, followed by really greater Europe, both the UK and Europe, both 10% each. Just the first time in quite some time that we're overweight that region, followed by Japan, which has two positions that perform quite strongly, and Australia and New Zealand. Portfolio is a large stock portfolio, very liquid. Welltower, Equinix, I've mentioned. Prologis, one of the largest REITs in the universe, largest listed industrial property owner in the world. You can also see the portfolio is well diversified by property sector as well as by region, with representation from all three major regions in the top 10, Europe as well as Japan representing Asia Pacific. Turning to the market, we find that listed real estate is trading at a discount to direct market values. And these are our estimates, not appraisal valuations, so we believe them to be accurate. So we think that you can access commercial real estate via the listed market at a discount to where you'd be able to invest if you bought those assets directly. And of course, you get all the benefits from a diversified portfolio, such as different sectors and different markets, and as well as liquidity and real-time price discovery. The operating fundamentals for commercial real estate remain quite strong. The chart on the left shows how occupancies remain at very elevated levels. That means utilization is quite strong. And then supply on the right side has picked up over the past decade, but in the recent year, it's come down quite a bit, and we've seen starts drop dramatically in the past 9 to 12 months, really as a result of a drying up of construction finance from the regional bank problems in the U.S., as well as greater financial banking regulation overall. So demand is strong, and supply is also really quite benign and becoming more benign as time goes on. So we're constructive on the demand-supply imbalance. See here another reason why supply is so challenging is that replacement costs have gone up so much in the past really 2-3 years. We've seen an increase in materials costs, in labor costs, and also in just the soft costs. Finance has gone up quite a bit, and then the entitlement process has become more arduous. And so there's real constraints to replication and new construction. As a result, with strong demand and limited supply, we're constructive on the outlook for rental growth and NOI growth for the various property sectors as listed here on the left side. And then finally, I mentioned REITs have very strong capital structures, leverage. The maturity schedule for REITs is really quite muted and laddered, as you can see in the chart on the left. And then on a loan to value basis, really a percentage of value, leverage for listed real estate is very close to really what's all-time lows. Certainly this chart shows the past 20 years, LTVs have never been lower in the US. We think that's true for other markets as well, with the exception being continental Europe, where loan to value is high. One of the other benefits for listed real estate is they can access multiple different debt capital markets. And as I mentioned, the concern with regional banks is an issue for real estate overall, but far less so for listed real estate, which has a much smaller exposure to bank debt, secured financing. As a result, I just wanted to point out how REITs are trading at a discount to global equities, really well below what is seen as warranted. So we think that there's value there as well. And then thematically, our portfolio is structured in the sectors that really matter for the economy. For retail, it's about necessity shopping centers. So the regional malls I mentioned before all have grocery anchors to them, both Nedgroup in Australia and Unibail-Rodamco in Europe. And then in the US, we have exposure to commercial shopping, strip shopping center companies, which are necessarily grocery and drug anchored. So that drives necessity shop and frequency. On the residential side, our portfolio is exposed to rental housing. In the US, coming out of the GFC over 10 years ago, there just hasn't been enough new supply of housing that's been created. As a result, demand exceeds supply, and we're seeing some of the rental housing companies that were born out of the GFC have very strong lease fundamentals. Invitation Homes is one of the larger positions in the portfolio. It's the largest listed single-family rental housing company in the U.S., and we expect its NOI growth to be in the 4 to 6% range for the next several years. We've talked a bit about data centers already. It's an important part of the market, important part of the economy, particularly as more and more activity happens in digital formats. And data centers is really where that digitalization is physically housed and transmitted. Logistics is an important part of the portfolio because of the increased drive towards efficiency, the onshoring that's happening as more and more inventories and production are being moved from Asia-Pac, really from China, into a major market like the U.S. and Mexico. In fact, I point out that the portfolio initiated a position in Fibra Prologis in the first quarter, which is about a $5 billion equivalent industrial portfolio in Mexico. And then healthcare, I've talked a bit about seniors housing. both in this call and in previous ones, remains an important part of the portfolio because we are just on the front end of what we call the gray wave, where you have the over 80 population in the U.S., which are the primary renters for seniors housing. Their growth is expected to increase by 3x over the next 10 years as you have the baby boomers age into prime rental years. Just talking a little about Equinix because it's one of the largest positions in the portfolio. It truly has a global portfolio. What's interesting here is that it has over 122 cloud on-ramps. This is where public users access the cloud. And in over 10 markets, Equinix controls all of the cloud on-ramps. So we find that it is a very strategically placed portfolio in a global data center framework. Additionally, it's very much a multi-tenant user portfolio rather than a single tenant user portfolio. As a result, we find that it's a bit less exposed to some of the great power demands and pressures that we're seeing in AI. We just talk a bit more about, see a bit more visually the digitalization of the economy. Moving over to Welltower, I talked a little about seniors housing and how strong that demand is. You can see here on the right just the acceleration of the over 80 population that we expect over the next several years. On the left, you can see how supply growth has slowed quite a bit. Invitation Homes, very strong rent growth. Not quite as strong as it was 2-3 years ago, but still we're expecting 4 to 6% going forward. And then you just see the housing affordability is very challenged as interest rates are higher. So the propensity to move out of rental housing into for sale is lower. And then just to throw in one that we don't often touch on is Nedgroup, which is a dominant student housing developer and operator in the UK, where we see very strong demand and an increased move towards modernization of student premises. We've talked about discretionary. And then office, we're seeing a bifurcation in the office market where newer properties, renovated properties, are attracting a disproportionate share of leasing. The non-renovated older assets are really struggling. We expect there to be accelerated obsolescence. The portfolio is underweight office with limited exposure to these more commodity-oriented segments by design. So as an outlook, REITs are really well placed in a challenging market. First, operationally, demand exceeds supply, and leasing conditions are pretty constructive for the most part. There's a few exceptions, of course. Secondly, capital structures are very strong, leverage is low, and they have great access to a variety of different capital sources. And then third, values are attractive relative to the direct market and relative to public equities overall. So we remain constructive on the outlook for global listed real estate. With that, thank you very much.